when this next big print hits, that's what's going to happen again. We're going to go from 50 or 60 or 70 to 240. This is the God candle phenomenon, right? I mean, it's a very volatile asset, and when it really runs, it runs hard. It's so volatile and it trades like a wild animal. My view is just, that it's going up and to the right over as Saylor says, if your time frame is 4 to 10 years, it's going up and to the right. So just buy it and sit on it.
In periods of market turbulence, even the most committed investors begin to question their assumptions. Volatility does not merely move prices, it exposes psychology. According to macro investor Lawrence Lepard, the recent drawdown in Bitcoin has triggered precisely this kind of emotional stress among newer market participants. Many investors, especially those who entered during strong price momentum, now wonder whether the foundational thesis has failed. Before we go on, please take a moment to like this video, subscribe to the channel, and turn on post notifications for more content like this. Every action helps with the YouTube algorithm and greatly supports the channel's growth. Thanks for your support and enjoy the video.
I've been getting a lot of nervous people that are newer in the space coming to me, looking at the price action and wondering if the thesis is broken or they've made a mistake. I guess maybe because I've been around it since 13 or 14, and since I watched it go from 17 to 9 and then 3 or 4, and then we watched it go from 65 to 15 and all this stuff. I mean, I'm pretty sanguine about the price, and it kind of reminds me, as Saylor says, it's digital capital. It's a very volatile asset, and you have to be willing to hold it on for a 10-year time frame. And I've always told people who are looking to get into it, they ask, how much should I buy? I say, you got to be, no matter how much you buy, you got to be willing to endure a 50% drawdown. Actually, probably a tad more than that. But, as we both all know, we've had 90, 80, 70, 60% drawdowns in the past. This drawdown right now, we're kind of 50% down from the high in October. And my sense is we could go 60% down. I don't think we're going to go 70 down. And we'll talk about why in a minute. But to me, what's going on here is just classic, fear and greed investor behavior that's as old as time. I mean, this is Buffett's, Mr. Market is, he's a manic depressive. And, at 125, people are chasing Bitcoin. It's going to 250, and at 67, nobody wants it, and it's going to 0. And, there's a good study that I tried to get a copy of it, but turns out it was pre-Chat GPT. ChatGPT refers to it, but they can't show me the original study. But I remember they summarize it, and the study is back in the 70s and 80s. There was a guy named Peter Lynch who ran the Magellan Fund from 1977 to 1990. Magellan had a 29% compound annual rate of return, which really puts him in Buffett-like stock picking categories. It was a fabulous fund. I mean, anyone who put money in it early and hung on to it just made a fortune. And Fidelity actually went back and studied all their customers and holders of the Magellan Fund, and they found that 50% of the people who at one point held the Magellan Fund did not make any money. They made 0 money. And the average return for the average person who invested in the Magellan Fund was 7%. So let's just think about how that happened. The ones who didn't make any money, they chased the Magellan Fund when it was doing well. They're like, this is great, I got to buy it. And they were chasing the high. And then when it turned down, they're like, oh my God, I made a mistake, I got to sell it, right? And everybody, it turns out, did so, or not everybody, on average, most people did some version of that, because if you had bought it in the beginning and held it to the end, your compound IRR would have been 29%. But, the average they found of all their customers over all those years was 7%. And so I guess what I'm trying to say is that human nature, it almost wires us to make investment mistakes, which is to say we chase price and we throw up on deep value. And this is how great investing fortunes have been made, for decades and centuries, which is, the blood is running in the streets. You buy deep value and you sell over valuation. I'm not suggesting you ever sell Bitcoin, but I'm pointing out that, there are these metrics that we use to determine what is great value and what's not great value. And right now, Bitcoin is in that great value zone. I retweeted it this morning. It's James Check's work, and it fits with the Tipmeyer multiple that right now, comparing the Bitcoin price to the 200-day moving average, we're at either 6% or 10%, depending upon whose numbers you use. It's only been this cheap 6 to 10% of the time. In other words, 90% of the time, it's been more expensive than it is right now. The other model I use this power law model, which Giovanni and Kruger have worked up, which shows that, they've drawn a curved line, log of time, log of price, that shows the price of Bitcoin over, its entire life. And they've managed to fit this curve to the data, 96% R squared, which anyone who's familiar with statistics knows that's good correlation. Having said that, it also varies a lot around the mean. It's a volatile asset. And, through all of its cycles, sometimes it trades at two standard deviations above the power law number. At its cheapest, it goes to one half a standard deviation below the power law number. It's never broken that. Right now, the power law mean says it should be trading at about 120, 130, somewhere in there. And half of that, half a standard deviation below that is 50 to 55. And so we're almost there. So, on both those measures, Bitcoin is extraordinarily cheap. I've been buying it. I've been selling gold and silver things to buy it. And I've been buying MicroStrategy as well, in size, actually, on both of those buys, just because gold and silver have taken off. And to me, what they're saying is, the big print's coming. The Fed's going to have to, debase the currency. And I think it's interesting they picked this guy Warsh, a hawk. I mean, it's a brilliant political move. Pick a hawk to do something really dovish. And they got him to buy in on he's going to have to be dovish. But because he's a hawk, he'll be able to sell it, right? And so that's coming, and gold and silver smell it. And Bitcoin's just on this lag program like it was in 2020. I've said this in other pods, I'll say it again. I mean, in 2020, I remember it very well because I own both Bitcoin and a lot of gold and silver, as most people know. And in 2020, when Powell pivoted and then, gold took off, it went up 50%. And from, I don't know, I think it was 1,200 around 2,000 back at the time. And all this, and gold stocks went up a lot. I did well. We were all feeling great. And Bitcoin was just bumping along between 5 and 9, kind of averaging 7. And then all the liquidity hit. Powell grew the balance sheet from, 3 trillion up to something trillion to, 9 trillion. It's just crazy. And it all came flowing into the system that summer. In October, Bitcoin went from 10 to 60x. It took like 6 months. It was really quick. And that's the way this asset trades. And so, when this next big print hits, that's what's going to happen again. We're going to go from 50 or 60 or 70 to 240. Well, they're already they started printing. I mean, they pivoted, right? They were tightening, then they stopped. Now they've got this reserve management program, which I think that's hilarious. It's just rebranding QE, right? They're saying, well, the banks need some reserves, so we're going to inject 40 billion a month in. Well, of course, that's going to have to grow. And that's just a mathematical fact. That's not, some, opinion. That's just mathematically proven that they will have to grow the money supply or the bank reserves. Now they're doing 40 billion a month, which is 480 a year, which Lynn has called the gradual print, playing off my book. And I'm like, yeah. And I responded to her on Twitter. I said, yeah, Lynn, but gradual can become big. And that's what I think is going to happen.
Lepard emphasizes a framework often articulated by Michael Saylor. Bitcoin should be understood as digital capital rather than a conventional speculative instrument. In this view, volatility is not evidence of fragility, but a consequence of monetization, the process through which an asset transitions into a widely recognized store of value.
So I don't know. I guess the point I'm trying to make is I think there are a lot of people. I had a call yesterday from a really good guy, very smart investor, but he's just kind of like, Jesus, I'm really heavily into this Bitcoin and I'm getting scared. And I was just kind of like, no. But he's newer. I mean, he hasn't been around it for 10 years. He's
gone through a couple of these.
Yeah. And I said, you got to relax, man. It's all good. I mean,
I think for some people, Larry,
you need the money in 3 months, you're fine. I mean, it's like, give this thing some time, right? And obviously it's easy for us to say that because our average cost bases are much lower, although I was buying it at 65 and I even bought some at 100. I didn't pay 125, but the point is that, I mean, it's higher highs and higher lows. I mean, that's the pattern. It's going to continue. There's no doubt that there will be those who chase it and then sell it and trade it. The thing that's tricky, and there was a very high profile analyst who, looked at the technicals and suggested this call and he made a good call. It was going to go down. The thing that's tricky with all that is it's a short-term gain. You got to pay tax on it. And when are you going to get back in? I mean, it's okay. So you sold great. You're a genius. You sold it for 95 or 100, or maybe you sold for 120. Are you going to have the guts to get back in at 67, or are you going to hold out for 40 and never get any more of it? You know what I mean?
Yeah.
Because the part about selling it when it runs is you got to think to yourself, okay, fine. What am I going to use? When am I going to buy it back? How cheap does it have to get to buy it back? And will I buy it back, or will I be left behind? I mean, I had an investor in my fund who sold it at 90 something and then it went to 125 and he was experiencing regret. Now he didn't go and buy it at 125, and I'm trying to get him to now buy it at 67, and I'm not sure if he will or not. I'd probably wait until it starts to turn, but it's also a levered asset with really rapid flows. And one of the things you'll learn if you read that Bitcoin 1 million book, Gary, is that from 2018 to 2024, it went up like 6x, okay, something like that. These are round numbers from memory, so I'm perfectly right, but the idea is right. And if you miss like the best 20 days of that period, you were flat. So, this is the God candle phenomena, right? I mean, it's a very volatile asset, and when it really runs, it runs hard. And so think about that. I mean, in a 6-year period where it multiplied in value by 6x, if you missed the top days, you didn't get it. And so for that reason, that's why I just don't trade it. I don't think you're smart enough to know what it's going to do next. And if you're not there when it goes on a tear, you missed it. And so
it's hard to buy when it gets up again and you missed it.
Well, that's exactly right. You sell it at 100, it goes to 70. You're hoping it goes to 60. Well, what happens if it suddenly, Worfs comes in and they do a big QE program, and the next thing you know, it's at 140. And now you sold it at 100. You felt like a genius because it went to 70. But are you going to chase it at 140? It's so volatile and it trades like a wild animal. My view is just, that it's going up and to the right over 4 to, as Saylor says, if your time frame is 4 to 10 years, it's going up and to the right. So just buy it and sit on it. Just hodl it. I mean, it's not that hard to do. I mean, it is hard if you're a trader to sit there and watch it go up and down. But if you're not, I mean, I don't care what it does any given day. Your emotions are your enemy in investing. And the older you get, the more cycles you see, the more you realize that. And that's where us older Bitcoiners can maybe provide some comfort and just perspective to some of these younger people who, I get it. They've got a lot in it. They've really made a bet on it. They believe in it, but they're looking at it now and they're saying, hey, hang on a second, is this broken? And my answer is no, not at all. I mean, which is not to say, by the way, that it couldn't dip down. I think that Mel and I were talking about this pre-show. One of the issues of where the price goes is the macro landscape. I mean, and so, if we get something that breaks, and we get a correlation of one event like COVID, March 1, or Lehman in 2008, guess what? Everyone scrambles for cash and liquidity until the Fed provides it, and everything goes down, a lot. And so, I don't know what the bottom on Bitcoin in that event would be. There probably is no bottom, but my sense is I'd be very surprised if it went below 50. And so, if you're looking at it today, to buy it at 67 with a downside of, 50, it was an upside of, kind of 250 to 400 the next 3-4 years. It seems to me like an incredibly asymmetric bet.
Lepard's perspective reframes market anxiety as a predictable stage within a broader macro transition. Bitcoin's volatility, rather than undermining its thesis, reflects its evolution as a global monetary asset shaped by liquidity cycles, behavioral psychology, and policy response. For investors evaluating the current environment, his message is not one of certainty, but of asymmetry. When an asset exhibits long-term structural growth, recurring deep drawdowns, and sensitivity to monetary expansion, temporary price weakness may represent not failure, but positioning.